All right, my clock shows 10 o'clock. I think we can get started here. Looks like a couple people are checking in via chat already. That's awesome. Good morning, everybody. I want to welcome everyone to today's webinar covering nonprofit compliance requirements. I'm sure everyone on the webinar today knows how hard it is to initially gain your nonprofit status, but maintaining it year over year can be tricky as well. So today, Carrie's going to cover numerous items that you need to keep your tax-exempt status. Before we start, I want to take a minute to introduce everybody here on today's webinar. So my name is Tyson Moore. I'm a supervisor. Also joining us today is Director Phil McKenzie, Senior Audrey Sadison, and presenter and partner Carrie Minnick. Just as a reminder, the webinar is live, it's interactive. So as Carrie goes through her presentation, the rest of us will be answering questions as she goes via the chat. If you have questions during the webinar, you can use the Zoom's question and answer feature at the bottom of your screen, should be in the toolbar. With that being said, I'll pass it over to Carrie to get started today.
Thanks, Tyson, and welcome everyone. As Tyson said, today's topic is nonprofit compliance requirements. So we're going to talk about what you need to do to keep your tax exempt status and some things that you shouldn't do to maintain your tax exempt status. So first of all, why is compliance so important? Well, we have a lot of different individuals, entities, businesses, organizations looking at us as a nonprofit. Donors, funders, and the public trust nonprofits to operate with transparency. Failure to comply failure to comply can mean penalties, loss of eligibility for grants, and damage credibility. So, most important really is our reputation. We don't want to impact that. So we want to make sure that we're doing what we need to do to keep our tax exempt status. So first of all, we're going to start at the federal level. So most important, IRS. So IRS is the one that granted us our tax exempt status. So in order to maintain that tax exempt status with the IRS, we need to make sure that we file an annual Form 990. So as many of you are probably aware, Form 990 is the annual information return that is required for all nonprofits, except for churches and religious organizations, that need to be filed with the IRS. It is due the 15th day of the 5th month after your fiscal year end. So for all of you December year ends, your return is due May 15th. For all of you June year ends, your return is due November 15th, which is coming up. Late filings can mean penalties. If you fail to file the return for 3 consecutive years, the IRS is automatically going to revoke your tax exempt status. So also along with that, if you file the wrong return, which we'll talk about here next, or if you file an incomplete return, the IRS considers that a return that is not filed properly. So that goes against that 3 consecutive years. So you want to make sure not only you're filing the return, but you're also filing the correct return. So very small organizations, those nonprofits that usually have less than $50,000 of gross receipts. And when we talk about gross receipts, we're again talking about gross, all revenue coming in from all sources. If you normally average less than $50,000, you can file Form 990N, which is the easiest form. It's a simple, what they call a postcard. Just asks for your name, organization, address, phone number, check the box that you have less than $50,000 of gross receipts. Pretty easy. If you have more than $50,000 of gross receipts, though, you'll have to file either 990EZ or Form 990. And you can see the level there of revenue and assets for each of those forms. Now, obviously, you can, if you have less than $50,000 or less than $200,000 in revenue, you could file a full Form 990 if you'd like, as opposed to an EZ or an N. But you just need to make sure that you do file the proper return. If you're a private foundation, you have to file 990PF. You have no option to file the other returns. Also, there are some restrictions on a couple different types of organizations, like supporting organizations, and a few other ones that are limited as to they cannot file Form 990N. But in general, this is kind of the overall requirements, filing thresholds for filing each of the different forms. If you're not able to file the form by the deadline, you can file an extension. It is a 6-month automatic extension, but you need to make sure that you file that request for extension by the initial due date. So if you're a December year end, your return is due May 15th. If you don't think you can get it done by May 15th, you can file an extension. You have to file that extension by May 15th. That extension will grant you till November 15th, an additional 6 months to file that return. And if you don't believe me that the IRS does take away tax exempt statuses, they do. And I got this information from the IRS website. So as of August 12th, 2025 on the IRS website, there were over a million entities that had their tax exempt status revoked from May 15th, 2010 to June 15th, 2025. Now, that seems like a lot, but some of those organizations probably were very small organizations, maybe that just kind of like started up, but then really didn't do anything. And so they really didn't have anything going on. And so they didn't file anything. Some of them, though, were probably legitimate organizations that should have filed and they didn't. In Fort Wayne alone, there was over 1,000 in that 15-year time span that did have their tax exempt status revoked. So again, you want to make sure that you do file your 990. If you fail to file for 3 consecutive years, the IRS will revoke your tax exempt status. It is very difficult well, I wouldn't say very difficult, but it's time consuming and expensive to have your status re-implemented. You have to go through and file the 1023 or 1024 again. You have to pay the fee. You have to wait for the IRS to approve it. You also, during that time, if you lose your tax exempt status, that means that funders probably will not provide grants and contributions to you because you're not considered a nonprofit. Donors, individuals that give to you cannot take a charitable deduction on their 1040. Technically, you are a for-profit entity, so you will have to file a for-profit tax return and pay income tax on your revenue. So it is really, really important that you file your 990 properly. You can go to the IRS website and look up your organization or any organization to see if they are registered for the IRS and to see what their tax status is, to make sure that they haven't lost their tax exempt status. So you can go to this website here that I have up on the screen and search for any organization. One other thing that I want to mention as we're talking about Form 990 is the public support test. Each year on Form 990, there is a Schedule A, that has to be filled out. Part of what Schedule A does is test to see whether the organization is a public, charity, or a private foundation. So if we go back to when a nonprofit initially receives its tax exempt status from the IRS, it is either considered a public charity or a private foundation. And this is based on where the revenue is coming from. Public charities are those nonprofits that get revenue from a lot of different sources So individuals, for-profits, other nonprofits, government, foundations, a lot of different donors, a lot of different people supporting them. Maybe some program service fees in there. Private foundations are those foundations that receive support from one or very few limited sources of revenue. So a lot of the foundations, like the family foundations that you'll see with the family names, those are considered private foundations because all their money comes from that one donor, that one individual. So either you're classified as a public charity or a private foundation. There are very different rules for public charities and private foundations. And so that's why you want to make sure that you stay in the correct category. Private foundations have to pay excise taxes. They are required to distribute a certain percentage of their assets each year. They file a different kind of they file the 990 PF as opposed to the 990. There's different rules. So once you're a public charity, you want to make sure you stay a public charity. And this Schedule A is what determines to make sure each year that your organization continues to be a public charity, that it's continuing to be publicly supported. So there's a calculation that is done, and it's a complicated calculation, but basically what it does is looks to see for that year and the previous 4 years, where is your support coming from? And it does a calculation to see whether you got 33 1/3% or more from the public. So the key is when you look at your Form 990, Schedule A, either Part 2 or Part 3, your organization only has to fill out one of these parts, depending on what kind of organization you are. You want to look on the lines that I have circled here to see what your percentage is. You want to make sure that that percentage is 33 1/3% or higher. If it is 33 1/3% or higher, that means you've met the public support test for that year and you continue to be considered a public charity, which is good. That's what you want. If that percentage is less than 33 1/3%, that means that you failed the public support test, and that means that you will likely be considered a private foundation. Again, you want to make sure that if you're a public charity, you stay a public charity. So this piece of the Form 990 is very important to make sure that you are continuing to be considered a public charity. So you want to make sure, again, what percentage your organization has on these lines. If it is going down, that should raise some concern. You want to look to see where your revenue is coming from. Also, something to be aware of is that if you get a very large grant from an individual or a private foundation or just something that you don't usually get, that could also skew this public support test. So you want to be aware of not only your percentage, but where your funding is coming from to make sure that you are continuing to be considered a public charity. So this is kind of part of that compliance as far as making sure you're a public charity. Just wanted to bring that up and make sure that everyone was aware of this important schedule that's part of the Form 990 that's done each year. So if we move to the state level compliance, and we're going to talk about just Indiana today, there may be some organizations with us that are outside of Indiana, but you probably have very similar compliance requirements, but we're going to focus specifically on Indiana today. So the first is the business entity report. This report is due with the Indiana Secretary of State, and it's due every other year. It's filed to maintain active status. Basically, the Secretary of State wants to make sure, hey, are you still around? Are you still doing business in Indiana? It is due the month and day the business was formed or registered. Whoever name that the Secretary of State has on file, there should be an email that goes to that individual reminding that individual that the return is due. So if that contact person has changed, you want to make sure you contact the Secretary of State to make that change. You have until the end of the month before the report is considered past due. There is a small fee that is due with the return. But the important thing here is that if you don't file this, you're considered administratively dissolved, which means you cannot carry on business activities in Indiana. And again, you must go through and apply for reinstatement. So it might seem like a kind of a small thing that needs to be done, but technically, if you fail to file this, you really can't do business in Indiana anymore. So please make sure that that gets filed every year. And I just wanted to note too, on each of the slides, I put a link to a website, so that way you can get more information for these different things we're talking about, and a copy of these slides will be mailed out to you after the end of today's presentation. Here is the Indiana Secretary of State's website, InBiz, and you can go on there and search for your organization or any other organization and to see when your next business entity report is due. It will say on there, once you put the name in there, when the next report is due. Or if you have been administratively dissolved, it will also tell you that. Next, let's talk about sales tax. And this is through the Indiana Department of Revenue. So if you are a nonprofit in Indiana, you must be considered a qualified nonprofit organization. So social organizations, they do not qualify for this. If you're a qualified nonprofit organization and you make purchases to carry on the nonprofit's tax exempt purpose, you can be exempt from paying sales tax. Now, there's a couple things here. The purchase must be invoiced directly to the nonprofit and paid directly via the nonprofit's funds in order to be tax exempt. So for example, if you have your employee go to Walmart and make purchases for your nonprofit, the employee makes those payments on their personal credit card and then the nonprofit reimburses that employee, that does not count. You should have to pay sales tax on those because the employee is making the purchase, not the nonprofit. So you want to make sure that when you make these purchases, all of the purchases are invoiced directly to the nonprofit and the nonprofit pays for it. So you can be exempt, like I said, from paying sales tax, which is great because that's a benefit of being a tax exempt entity in Indiana. But in order to do so, you must register for a sales tax exemption with the Indiana Department of Revenue. That's Form NP20A. So all of you that have been in existence for a number of years, you would have already done this. But you have to file an NP20R by May 15th every 5 years in order to remain registered. So this is a change. In July of 2022, the Indiana Department of Revenue changed rules relating to sales tax. And along with that, they made this change. It used to be that every year when you filed your 990, whenever that was due, you would file a Form NP20 with the Indiana Department of Revenue. That changed. That no longer exists. So that Form NP20, which kind of maintained your sales tax exemption every year, has now been replaced by Form NP20R. So again, this was a change. So the first time you file NP20R is based on when your organization's EIN, that number, that in the last 2 digits. So as you can see, for those nonprofits that have an EIN that ends in 00 to 2024, you should have filed your first NP20R last year on May 15th, 2025. And then you can see the subsequent ones that are due. So that's the first time you file it. And then you'll need to file this NP20R every 5 years from that initial due date. If you fail to file this return, then you won't be able to be exempt from sales tax exemption. You also must file this return online through your InTime account. So if you don't have an InTime account set up, you probably want to go and have one set up. I have included a screenshot of that website on the screen there. So for some of you where DWD has prepared the 990 in the past and also has prepared that NP20 for you, we will not be preparing Form NP20R going forward because again, it must be filed electronically through the organization's InTime account. So you want to make sure that that is done through your InTime account. Again, that on the first due date is based on your last 2 digits of your EIN. And then after that first due date, it is due every 5 years going forward. All right, moving on. So that is sales tax for when a nonprofit pays sales tax for purchases. Now there's the other side of it is when a nonprofit makes sales. So again, when the Indiana Department of Revenue made this change back in 2022, they made a change to collecting sales tax. So it used to be that this rule that if a nonprofit sold things for less than 30 days during the year, then you didn't have to pay sales tax. You didn't have to collect and pay sales tax. Well, they changed that. So it's gradually, after a couple changes, they increased it to $100,000. So if a nonprofit makes sales of total sales of $100,000 or more of tangible personal property in a calendar year, you must collect and remit sales tax. When we are talking about sales, we are talking about sales for everything, whether it be like your t-shirts with your organization's logo on it. We're talking about auction items at fundraisers. That's considered a sale. We have to add all of those revenues together. And if they get to $100,000, then that's when we have to start collecting sales tax. So until you reach $100,000, you don't have to collect sales tax. But once you reach $100,000, that next event that you make a sale, that's when you have to start collecting sales tax and remitting it. Once you reach that $100,000 threshold, you have to continue to collect sales tax until you make less than $100,000 in sales for 2 consecutive years. So the key here is, where are you getting your sales? You have to account for all the different activities at all the different locations, add them together. And then once you reach that $100,000, that's the key there, that $100,000, then that's when you have to start collecting and remitting sales tax. There are some specific exemptions for nonprofits, such as churches, religious organizations, public schools, parochial schools, and youth organizations focused on agriculture. This $100,000 sales rule does not apply to them. They are completely exempt. But if you are not listed in that exempt list at the bottom of the screen, then the $100,000 or more in sales does apply to you. So I know some nonprofits, this isn't going to apply to at all because you'll never reach the 100,000 in sales. But some nonprofits that do have large fundraising events where they auction off a lot of tangible items, they may easily reach that $100,000 threshold. So that's just something to keep in mind there. The Indiana Department of Revenue has a lot of good specific examples on their website. So if you go to the link at the bottom of this screenshot here, then you can get more information. There's a sales tax bulletin number 10, which is application of sales tax to nonprofit organizations. So I highly encourage you to review that as well if you think that this may apply to your organization. Moving on to state employment filings. So again, in Indiana, we need to, as far as related to like payroll, we need to make sure that we file Form WH-1 monthly or quarterly with the Indiana Department of Revenue. There's an annual Form WH-3 that has to be filed. That is for taxes that are withheld from your employees' payroll. Also unemployment insurance. So in Indiana, you are considered an employer if you employ 4 or more individuals in 20 weeks of a year. So it's a little bit different than for-profits. So specifically for nonprofits, you have to employ 4 or more people for at least 20 weeks in a year to be considered an employer. If you do not do this, then you are not considered an employer in Indiana, and unemployment does not apply to you. 501c3 organizations, only C3 organizations, may elect to reimburse the state directly for unemployment claims instead of paying taxes. And that is something that you fill out when you initially become a nonprofit. So there may be some of you 501c3 organizations that are not paying into SUTA every year or every month, I'm sorry, but you only pay in if you were to have a claim. And then also the quarterly wage and contribution reports, your UC1s, are due to the Department of Workforce Development. So if you don't have employees, you don't have to worry about this, but I imagine most of you do have employees. Okay, next let's talk about the E1 annual entity report. This is different than the annual business annual report that gets filed with the Indiana Secretary of State. This report gets filed annually with the Indiana State Board of Accounts. This is required for all nonprofits that receive any type of government assistance. This would be whether it be federal, state, or local. So if you're a nonprofit that gets any kind of government assistance, you are required to file this form with the Indiana State Board of Accounts. It is due within 60 days after the end of your year end. So if your end is December, then it's due at the end of February. It must be filed electronically through the State Board of Accounts gateway system. And this is a screenshot of what their website looks like. So what you do is you go on there, set up an account, and then there's a form that asks you where you got your government assistance from. So you're gonna list each one of your government grants and what is it a direct grant from a federal entity? Is it from a state entity? Is it from a local entity? Is it a fee for service? Is it a pass through? And then there's a few other questions that you have to answer. And then the State Board of Accounts is going to determine whether you have to have an audit done. Whether you have to have an audit done is based on how much revenue you're getting compared to your total revenue and expenses. So they determine, yes, we think you need to have an audit done, or no, you might not have to have an audit done, in which case they will send you an email that says you have a waiver. If you have to have an audit done, you go ahead and have your audit done, and then you'll need to upload your final audit to this Indiana Gateway for the State Board of Accounts to show that you had your audit done. In some instances where you have a waiver and you don't need to have an audit done, they may still ask you for your 990, so you'll need to upload that for them. But regardless of what the outcome is, if you get government entity and you are an Indiana nonprofit, you need to fill out this form to see if the State Board of Accounts is requiring you to have an audit done. All right, so that's state. So let's talk a little bit about corporate governance requirements. So as a nonprofit, you're required to maintain bylaws. You need to make sure that you update them when major changes occur. So make sure that you are reviewing your bylaws every so often to make sure that, yes, this is how we're still doing things, or no, we need to change this. You also are required to hold regular board meetings and maintain written minutes on file. And then there's also your fiduciary duties for your board members, the duty of care, loyalty, and obedience. And just to show you that, yes, the state of Indiana, in their Indiana code, specifically says certain requirements about nonprofits. One of them is that a board of directors must consist of at least 3 individuals. So if you do not have 3 individuals on your board of directors, I would suggest that you go and get additional board members to meet the minimum requirement. The Indiana Code also says that as far as officers, you must have a president, a secretary, and a treasurer. You can have other officers that you appoint, which is fine. But again, the code is saying, hey, you really need to have a president, a secretary, and a treasurer. It also goes on to say that you need to maintain minutes. So written minutes, please keep them, that are a record of actions taken by the committees as well. So you need to keep committee meeting minutes as well as board meeting minutes, and that you shall also maintain appropriate accounting records. Also goes on to say that these are the items that you shall keep a copy of: your articles of incorporation, your bylaws, your minutes, and also the names and business or home address of the corporation's current directors. So if you don't have this documentation somewhere within your organization, it would be a really good idea to make sure you have all these items in your office. So that way you are in compliance with Indiana. And as far as being in compliance, there are certain policies that are really considered to be required by nonprofit organizations. The first is the conflict of interest. If you are an organization that has just recently received your tax exempt status, the IRS definitely makes sure that you have a conflict of interest before they give you that tax exempt status. I don't know that they've necessarily always requested a copy of that, but I know here in recent years, that is definitely something that they ask for. So making sure you have that written conflict of interest. Also, a whistleblower policy is something that came out of Sarbanes-Oxley many years ago that is specifically not only for-profit entities, but also for nonprofit entities. So having a written whistleblower policy that says, you know, if someone, a volunteer, an employee thinks that something funny, something that's not funny, but something that's not right is going on within the organization, that they have a method to report that, and also that there is no, they won't get fired from reporting that. So making sure you having that policy in place. And then also a document retention and destruction policy, which states what kind of documents that you maintain. So your bank statements, your check copies, your minutes, your bylaws, all those different types of documents that a nonprofit has, and how long you keep each one of those. And then also when it's time to get rid of them, how they are destroyed. It should also include a sentence or a paragraph that says that if a lawsuit is imminent or if possible, then you need to stop all shredding. So if you do not have a copy of a conflict of interest statement, whistleblower, or document retention and destruction policy in place, I would suggest that you put one in place. If you need a copy of those, a template, we would be happy to provide you with one. Just let us know. There's also some policies specifically related to kind of compliance that I've listed as far as best practices. Obviously, there's many more best practice nonprofit policies, but these are kind of specifically related to compliance. Board member job descriptions and expectations. You know what, I'm sure like your employees each have job descriptions, so really need to have one for board members as well. What are their expectations? Give this to them when they sign on. Usually have them sign it. A board self-evaluation policy to make sure that the board is doing what they're supposed to be doing. Are they being effective and efficient? A succession plan, not only for your executive director, but also for your key board members, officers, you know, who's going to step up. Oftentimes that succession plan kind of includes different variables, maybe one where it's like a short term where the executive director may be off for a family situation or a short-term illness, and then a longer term or permanent. So in these different cases, who is going to take over? The key with the succession plan is that you want to make sure that in the absence of that person, that the organization continues to operate how it's supposed to. You don't want to sever any relationships or lose any relationships. You want to make sure that you're just, keep going with your programming and your funding and everything, to make sure that there's nothing stops or that there's no sudden issues if someone were to leave the organization. And then finally, a code of ethics or a code of conduct. So again, if you don't have those, I would encourage you to consider putting them into place. Again, if you would like templates, please just let us know and we would be happy to provide those to you. So we want to throw in there some financial as far as making sure you're in compliance. So with the financial management and internal controls, the biggest thing is just making sure that you have segregation of duties in place. And the next couple screens here just kind of provide some examples of how to properly segregate duties between 2 people, 3 people, and 4 people. And again, a copy of these slides will be provided to you so you can see them in more detail. But each one of these slides really talks about, okay, if we want to segregate duties and we only have 2 people, 3 people, or 4 people, this is the best way to do it. Because again, making sure that we are segregating the duties of custody, approving, who has access to it, actually recording the transactions. So that way we can limit the possibility and opportunity for fraud. So making sure that there's proper segregation of duties in place. These slides do refer to accountants. They don't necessarily need to be an accountant. The key is that there's different people within the organization providing these duties to properly segregate duties as much as possible. Could be a board member, include your board treasurer. That's always a good one as well. Along with segregation of duties, we want to, maintain documentation. We talked about having a document retention and destruction policy in place. It's very important to make sure that your nonprofit is maintaining proper documentation. It is required by both the state of Indiana, as we noted in the code, it says that you're supposed to maintain proper accounting documentation, but also the IRS. Not only because you need that information to record it on your annual 990, and prepare financial statements, but we need to make sure that as far as revenue, that if we get any types of restricted revenue from donors, that we are complying with what they want us to do. Also to prove where we're getting our revenue from, whether it's contributions, whether it's a fee for service, and then also our expenses going out, what we're spending our money for. As a nonprofit, we are, these are not an individual's funds. These are to support the organization's mission. And so we need to make sure that we are using the funds properly and in a responsible manner, and that they are being used for legitimate business purposes. So making sure that we have invoices to support all of the expenses and that we can show that they are a legitimate business expense to further the organization's operations. It just makes it much easier if we document everything and have proper documentation. So that way, if someone were to come in and question what we're doing, we can say, nope, look, this is our documentation that supports that, and that we're doing the right thing with the organization's funds. Again, maintaining a document retention and destruction policy, how long we keep each document, how we destroy them. And again, when we're talking about documentation, it doesn't all have to be on paper. You can certainly keep electronic documents. We work with a lot of organizations that they don't have paper. It's completely electronic, which is perfectly fine. You just have to have a method in place and a policy in place on how to maintain those documents. Governance documents that is usually included in the document retention destruction policy, like the bylaws, your articles, IRS determination letter, those things you usually want to maintain permanently. Financial information like bank statements, reconciliations, invoices, check deposit slips, those types of things. Usually a lot of those are kept for 7 years. But again, if you want a policy template, we can certainly provide that to you. And then HR is really important too, to make sure that you're maintaining the proper documentation for your employees. Normally with HR, documentation needs to be maintained while you employ the individual, but then also for a certain number of years after the employee has left. So make sure again that we are maintaining the proper documentation to support all of our activities. because we are a tax exempt entity. And so in order to prove that we are continuing to follow those tax exempt requirements, that documentation will show that, yes, we are a legitimate nonprofit, tax exemption, we have it, we deserve it, and we're following the rules to maintain it. Next, I want to talk very briefly about fundraising compliance. Fundraising is regulated to protect donors and the public. Obviously, you want to be truthful in your appeals. Don't exaggerate or misrepresentation the use of the funds. We want to make sure that we acknowledge contributions properly. For an individual to receive a charitable deduction on their 1040, they have to have proper supporting documentation from the nonprofit that proves that they made this donation. So normally a nonprofit will write them a letter, a thank you letter, either at the time of the donation or at the end of the year that includes this information. So there are specific things that need to be included. It is the individual's responsibility to get this documentation from the organization if it is $200 or more. It's not necessarily the nonprofit's responsibility. However, it's best practices that the nonprofit just provides that. We don't want to make our donors mad, and we want to make it easier for them. So to make sure we provide that documentation that shows the dollar amount that was given, when it was given, the donors, the organization's name, and so forth. Now, there are instances where a quid pro quo transaction occurs, and this is primarily for your fundraising events where they purchase a ticket for $100 and $75 is a contribution and $25 covers the food. So in those instances where there is a quid pro quo transaction of $75 or more, it is the nonprofit's responsibility to make sure that the donor receives that written documentation. Next, restricted gifts. We want to make sure that if somebody gives us money that's restricted for a specific purpose, we need to make sure that, number one, we're maintaining the documentation that shows what that restriction purpose is for, and that we're also spending that money on that restricted purpose. We are really legally obligated to follow the donor's instructions on how that money must be spent. So we really want to make sure that we follow what they want that money to be spent for. And then also, really quick, there are certain registration rules for different states where you solicit donations. They can get kind of messy and confusing as far as what is considered soliciting donors. I'm going to refer you to the National Association of State Charity Officials, and I have their website at the bottom of this slide. They can provide some additional information on that. Just want you to be aware that when you do solicit donations, whether it's in person or online in different states, there may be some different rules that you have to follow for those different states. So I would encourage you to go visit their website if you are getting a large amount of donations outside of Indiana. I mentioned the quid pro quo. So here's an example of a donation. Someone can make a contributions of $150. They get a cookbook in return. The fair market value is the cookbook is $25. So therefore the contribution is $125. So pretty simple, but they do need some kind of documentation from the organization showing that quid pro quo transaction. There is actually a penalty on the nonprofit if you do not provide this of $10 per contribution, not to exceed $5,000. So you want to make sure that you do provide this to donors. The next slide talks about the written acknowledgement requirement. So this is just like in general, if somebody is giving you a contribution, it's best practices, and this is what they need as an individual. Written documentation, and it can be electronic, that includes the name of the organization, the dollar amount of the cash contribution. Now, if they were to give you a non-cash item, so let's say they went out and bought a bunch of books for your reading program and they donated a large amount of books to your organization. you're going to provide a description, but not a value. Do not put a dollar value of non-cash contributions in this letter. That is not your responsibility. That is the donor's responsibility. So in this case, you would just say, thank you for your donation of 25 books to our reading program on whatever date. You would also include a statement that no goods or services were provided by the organization if that is the case. If there were goods or services provided, you would need to include a good faith value of what was provided. And so, yeah, I think that's the main items there. So again, a donor can deduct a charitable contribution of $250 or more only if they have this information. So you want to make sure that you give this to them. They also need to have it by the earlier of the date the donor files their tax return, or the due date. So April 15th. You want to make sure, just best practices is that you give them this, summary by the end of the year or right after end of the year for that year. Again, the donor is responsible for requesting and obtaining this written acknowledgement from the organization. However, it's really best practices that the nonprofit just provides this to all their donors as well. Next, we're going to talk briefly about employment. So HR, you as a nonprofit, you need to follow the same laws as a for-profit. So we talked a little bit about what is considered a nonprofit employer in Indiana. So you need, another thing that is really big is correctly classifying workers. There are employees and there are independent contractors. The IRS is very, very big on making sure that you are classifying people correctly. Because if you are classifying people as an independent contractor and really they are an employee, that means you are not properly withholding payroll taxes and remitting payroll taxes to the IRS. They do not like that. So again, misclassification is a major risk. There are some specific standards that kind of say, hey, if this is happening, it's an independent contractor, or if this is an employee. So the biggest thing is the relationship. So if you're telling this individual when to work, where to work, and you're providing tools for them to get it done, it's an employee. If not, if it's more of, hey, I'm hiring you to do this project, you get it done when it needs to be done. It just needs to be done by the end of the year, and you provide this kind of service to other organizations, then it's going to be more of an independent contractor. So very big deal to make sure that you're classifying your employees or independent contractors correctly. You also want to make sure that you file and pay payroll taxes on time. If you don't, that is something specifically that can come back on your board of directors at a personal level, and they could be held liable. So you want to make sure that you're withholding the proper payroll taxes and paying them properly. Comply with any type of minimum wage, overtime, non-discrimination laws. And then also, if you offer benefit, just make sure they're reported properly and administrated correctly. So pretty much the same rules that for-profits have. You can go to the Indiana Department of Workforce Development. They have a really nice employer handbook there that goes into more details as to, paying proper payroll taxes, benefits, and so forth. Unrelated business income is the next topic. So this can be a very gray area. However, you should be aware of it. The definition of unrelated, okay, so first off, nonprofits don't pay income taxes. That's why you are exempt. However, you are required to pay unrelated business income tax, which is different. Unrelated business income taxes are paid on unrelated business income. Unrelated business income is generated from activities that are considered a trade or business, regularly carried on, and not substantially related to furthering the exempt purpose of the organization. So all three of those items under definition must be met in order to be considered unrelated business income. So some examples: advertising. Advertising is a big one. That is considered unrelated business income. Also, facility rentals, merchandise sale that's not related to your exempt purpose. Those are just a few examples. There's other obviously unrelated business income activities, but those are kind of the more common examples. When we're talking about unrelated business income, the key to it is what activity is generating the income. The IRS does not care if you're putting all that income back into your nonprofit to further your exempt status or your exempt purpose. The IRS does not care if you take all of that income and you donate it to another nonprofit. Does not matter. Does not matter what you do with the revenue. It only matters what activity generated the revenue. And that is whether when they consider it unrelated business income or not. If you have some unrelated business income, that's fine. It's a great way to add additional funding to your organization. However, the IRS does not like it when your organization has a substantial amount of unrelated business income. Unfortunately, the IRS does not define what substantial is. In some instances, it is 20%. In some instances, it is 80%. So it just depends on the facts and circumstances. And that is really a lot of what surrounds unrelated business income is the specific facts and circumstances to your organization. What can be considered unrelated business income for organization A might not be considered unrelated organization or unrelated income for organization B because they do something totally different. So just because organization A has this and it's considered unrelated business income doesn't mean that if organization B does the exact same thing that it is considered that. You have to pay, again, as I mentioned, business income tax on this revenue. So you take your unrelated business income and you deduct the related expenses, and then you deduct $1,000 standard deduction to come down to a net amount. And then you have to pay tax on it at the corporate income tax level. So again, it's okay to have some unrelated business income, but if you have too much, the IRS does not like it because they're saying, well, we gave you a tax exempt purpose, a tax exemption to do a nonprofit purpose. What you're doing here is not a nonprofit activity. It is an unrelated business income activity. Therefore, you should have to pay taxes on it, just like the for-profit down the street that's doing the exact same thing. So just be aware that if you do have unrelated business income, you need to file a Form 990T with the IRS and also a Form IT-20NP with the state of Indiana to report that income and pay those taxes. So you want to make sure that you're also recording these properly in your accounting system to make sure that you can figure out what is unrelated business income and then also the expenses that go along with that. So if you have questions on this, again, it's such a gray area and a case-by-case basis, please reach out and we'd be happy to talk further to you about your specific circumstance. Okay, next I want to talk about government funding, because if you get government funding, then you have a whole other level of compliance that you need to deal with. So, and I'm talking specifically about getting money from the federal government. So each funding source, each government grant is going to have a grant agreement. And that grant agreement is going to have specific terms. So first of all, you need to make sure that if you're getting money from the federal government, that you have a copy of the grant agreement and you need to read that and you need to understand what it is asking you to do, because it's probably asking you to do a lot, not only with the funds, but the reporting, how you use the funds and so forth. So there's going to be a grant agreement that has certain terms in it. Well, also there's this thing called uniform guidance that the Office of Management and Budget puts out every year. And it talks about different cost principles, procurement rules, different compliance requirements that each grant has to do. So each grant given from the federal government is assigned an assistance listing number. And it is like, 93.421 or something like that. So each one of these grants has a number. And in this uniform guidance, each one of those grants is listed. There are some that might not be, but most of them are listed in there. And then this compliance supplement also has certain requirements on how you spend the money. If you get this government money, federal government money, and you expend more than $1 million, this used to be $750,000, but it was most recently increased to $1 million, you're required to undergo a single audit. So this is a special kind of audit. It includes a financial statement audit, which most of you are probably familiar with, but then there's also a compliance piece where your auditor has to go in and test where you're getting your government money from and if you're spending it correctly and so forth. having a single, if you've not had a single audit done in the past and you discover that you need to have one done, the cost will be much higher than a regular financial audit, and there will be a lot more work that needs to be done, not only by your auditor, but by you as the organization being audited. Again, the single audit includes both the financial piece, but also it focuses on internal controls and compliance with the grant requirements. So again, we're going to go as an auditor to that Office of Management and Budget compliance supplement to see what kind of things you were supposed to do or not do with this government funding and make sure that you did that properly. If you get federal grant money, there are also specific written policies that you need to make sure you have in place, such as procurement policy, allocation of expenses. So you need to make sure you have all of that in place. Once the single audit is done, the reports are public. Anyone can go and look at it, and they must be submitted to the Federal Audit Clearinghouse. As we mentioned earlier about the Indiana State Board of Accounts, if you get federal money, the Indiana State Board of Accounts may also require you to have an audit done. This is a screenshot of the Federal Audit Clearinghouse website. So if you are required to have a single audit done at the end of your audit will be uploaded to this website, and then anyone can go and look at your audit and any kind of findings that you have as well. So the key to remember here is if you receive federal money and if you spend $1 million or more during your fiscal year, you may be required to have a single audit done. You need to make sure that you have that done timely, as it is that single audit report to this Federal Audit Clearinghouse is due at the latest 9 months after your year end. So you want to make sure that you have that done. So again, if you get federal money, there's a lot more requirements and compliance that you have to deal with. So make sure you think about that before taking on a federal grant that you've never had before. So I want to also talk about just some common pitfalls to avoid as a nonprofit. Political activity. A 501c3 organizations are specifically exempt or specifically prohibited from engaging in any kind of political activity. So you cannot make any contributions to any type of PAC. There can be no public statements in favor or in opposition to any candidates. Just don't get involved in any kind of public activity. Now, you can provide like educational type programming for people like voting. So you could say like, here are the different issues at stake during this political season. This is what they mean. Like you can provide education type resources for people, but you can definitely not say, hey, vote for this person or this person. Now, there's also lobbying. Lobbying are activities that are intended to influence legislation. So this is different from political activity. 501c3 organizations may do some lobbying. It cannot be substantial, but it has to be limited. So if your organization does get involved in lobbying, you just need to watch how much lobbying you are doing. Then there's also advocacy. Now, advocacy is what every nonprofit should be doing. You are educating people about the effects of policy on your constituents. So that is what everyone should be doing, educating on how different things impact the people that you represent. So keep that in mind, specifically if you are a 501c3. No political activity, some lobbying is okay, advocacy is great. That's what you should be doing. Next is private benefit. And private benefit kind of goes with the next two slides we're going to talk about as far as inurement as well. So private benefit is bad. We don't want any kind of private benefit. So who are we talking about here? So we're talking about outsiders, not connected to the organization. So we're not, in this instance, we're not talking about board members or executive directors. We're talking about just like people in the public. So this occurs when a nonprofit's activities give more than an incidental benefit to private individual or entity. So your nonprofit is benefiting a private individual. The IRS specifically says that 501c3 organizations are not to benefit a private individual. So for example, a nonprofit has a job training program and it is designed primarily to meet, lost the T there, to meet the staffing needs of one private company. So in that instance, this nonprofit who has this job training program, this job training program is specifically designed to benefit one public company that's out, or one private company that's out there in the public. That is not why a nonprofit should exist. So this violates the requirement that a 501c3 organization is operated exclusively for public benefit. So no specific company or individual is benefiting from this organization's activity. So we want to watch who we're benefiting. Next is inurement. So this is kind of similar. However, this is dealing with insiders. So this is the people within the organization that have influence. So this could be your board of directors, your executive director, key employees. So, and again, this is very similar. When an insider personally gains from the organization's earnings or assets. So for example, if the executive director sets her own salary at an excessive level or uses organization funds for personal expenses. Now, this is really bad. We hope that nobody's doing this, but that would be considered inurement. So any amount of inurement violates the IRS rules and can result in immediate loss of tax exempt status. Then we have excess benefit transactions. So excess benefit transactions focus on disqualified persons. So again, these we're talking about the insiders or their family members or business partners, those type of people. So this is when a disqualified person receives more than an economic value from the nonprofit than they provide in return. So for example, again, paying unreasonable compensation, selling nonprofit assets, loans. So again, this is very bad. We don't want this to happen. And as a result, we could have excise taxes that are due not only on the individual where that disqualified person has to pay a 25% excise tax on the excess benefit, but the individuals, the board members who approve the transaction may also have to pay excise taxes. So bottom line is we don't want any individual to benefit specifically from what the organization is doing. The organization is in existence to benefit the public as a whole, not specific individuals. Also, we don't want to commingle funds. Don't ever commingle personal and organization money together in the same account. Also commingling restricted and unrestricted funds. Now, I'm not saying that you can't put restricted and unrestricted funds in the same bank account. Yes, you can certainly do that, but I'm talking more of, in this instance, making sure that you're tracking them properly and using them properly. And then the same way with federal grants, making sure that you're tracking them properly. You can put federal grant funds in with unrestricted operating funds. That's perfectly fine in one bank account. You just need to make sure that you're tracking these separately for the reporting requirements that need to be done for each of these. And then finally, I want to leave you just with some practical tips for staying compliant. Create an annual compliance checklist of all of the reports that have to be filed with who and when. Train your board on their compliance responsibilities and also your employees. Work with professional advisors if you aren't sure, your accountant, your attorney, HR professionals as to, hey, you know, I have this going on within my organization. What does that mean? What do I have to file? Set calendar reminders. Documentation. Documentation is big. Make sure you have everything documented. If you receive government funding, just because there's so much additional compliance that needs to go on with that government funding, assign someone within your organization to be like the government guru. They need to be the one that tracks all the requirements, make sure that everything is done properly, make sure that everything is filed properly. And then finally, our last slide here, I just wanted to leave you with a link to our website. Thank you for joining us today. We always really appreciate you taking time out of your day to listen to what we have to say. Hopefully it was helpful. If you're looking for more resources for your organization, we have our Mission Minded blog that talks about all things nonprofits, whether it be 990s, board service, UBIT, all kinds of things. We also have our upcoming webinars that you can sign up for. We have one more this year in December, and then we'll start over again in next year. We also have prior webinars that you can access. They have been recorded, so you can go to our website and access those prior ones as well. And other than that, I just thank you again for attending and all that you do for our nonprofits. Thank you.